Very good morning, everyone. You're watching Market Cafe on ET Now with me, Kanishka, and my colleague Shreyansi. Well, a very positive handover from the Wall Street, Shreyansi, after the Fed held interest rates steady. What are you picking up?
Well, absolutely. That just about sums it up, Kanishka. And a very good morning to you. Firstly, let's take a look at the handover coming in from the Wall Street. Then, when you take a look at the Fed, of course, they kept the federal funds rate at a range of 4.25% to 4.5%. That was in a widely anticipated move. So nothing out of the realm of possibilities that we were thinking of previously. So it is a widely anticipated move that we've had come in. But when you take a look at the markets, of course, you do have them regaining some footing. That is something that you're looking at after we've seen the kind of sell-off that has been going on since February, in fact. So when you take a look at the Dow, currently in the last session, you did have that jumping 0.9% for the Dow. S&P 500 as well surged just over 1%. So that's the kind of move that you're looking at as far as S&P 500 as well as concerned. Even the Nasdaq Composite, that's the one that's gained 1.4% but remains in correction. That is, the index is still more than 10% off its high as well. So that's the kind of wrap-up that you're looking at. In terms of the markets, the S&P 500, which briefly also slipped into correction territory last week, is now more than 7% off its record high as well. So that's something that you have as far as the handover is concerned for both of these indices. Now, the broad market index also on pace to break a 4-week losing streak. Largely, that's the kind of handover that you're looking at. But Kanishka, tell us a little more about oil prices as well in terms of the handover that we have, because quite the steady move coming in as far as oil prices are concerned.
That's correct. Here's a quick commodity check. Oil prices held steady Wednesday as the Federal Reserve sees heightened economic uncertainty. The Fed held interest rates steady as expected, though it did indicate that cuts are likely coming later this year. But the central bank noted in a post-meeting statement that is, the uncertainty around economic outlook has increased. Brent crude futures rose less than 0.5% to close at $70.78 a barrel. US West Texas Intermediate crude also gained about 0.3% to settle at $67 a barrel. Crude futures, though positive through the day, is slightly in the wake of Fed's decision. Traders are worried that President Trump's tariffs could slow economic growth and hit oil demand. In fact, U.S. crude stocks rose by 1.7 million barrels to 437 million barrels last week. This is higher than the 512,000 barrel rise analysts had expected. However, distillate inventories, which include diesel and heating oil, fell by 2.8 million barrels last week to 114 million barrels, versus the expectations for a 3 lakh barrel drop. Now, oil prices eased about 1% in the previous session after Russia agreed to US President Donald Trump's proposal that Moscow and Kyiv temporarily stop attacking each other's energy infra, a move that analysts say increases the chances for peace and could eventually pave the way for Russian oil to enter global markets. The prospect of a full ceasefire remained uncertain, though. Russia and Ukraine accused each other on Wednesday of violating a new agreement to refrain from attacks on energy targets just hours after it was agreed by Trump and Russian President Putin, but the prisoner swap went ahead. Moving on, in terms of the bullion, gold prices edged higher to hover near the all-time highs after the Fed stayed put on the rates as widely expected. Now, spot gold was up 0.2% at $3,039 per ounce after hitting an all-time high of $3,045 earlier in the session. U.S. gold futures settled mostly unchanged at $3,041. Gold, traditionally viewed as a safe haven investment during times of inflation or economic volatility, has climbed over 15% so far this year. Remember, gold becomes more attractive when interest rates are low, as it is a non-yielding asset. Now, going back to oil once again, keeping it with the oil and gas space, Trump met with more than a dozen of oil and gas executives at the White House as the industry lobbies the administration to slash regulations. The discussion focused on permitting and regulation and charted plans to boost domestic energy production amid falling crude. And the meet also focused on reforming the need to build a national electricity grid to compete with China. Exxon and Chevron, the biggest oil producers in the US, however, declined to comment.
Alright, then that's the latest coming in as far as oil prices are concerned. Lots to look at bright and early this morning. But tell you what, let's also take a look at the cues that we should be keeping on your radar. Then, when you take a look at the US, of course, you do have jobless claims, and from the UK as well, jobless claims data, something that you should be looking at. Unemployment data as well that you should be looking at. And in terms of China, you do have the loan prime rates, so that's something that you're looking at as well from China. But moving on, then, when you take a look at global earnings, keep Accenture, Nike, as well as Micron Technology on the list as well when it comes to earnings. Lastly, to buy shares to be eligible for dividend for a host of counters, and the ones that I'm talking about, as you can see on your screens, are IRFC, CG Power, as well as NMDC. So those are all the three counters that you should be watching out for on the back of dividend eligibility. Those are all the cues that we're looking at bright and early this morning, but lots of headlines also to take a look at, Kanishka.
Correct. Let's get tracking top headlines in this hour. Central banks across the globe are holding rates steady, from a Fed to a BOJ and now the PBOC. First up, key takeaways from the second day of the FOMC meeting. Interest rates held steady as expected in the range of 4.25% to 4.5%. However, the FOMC has downgraded its collective outlook for the economic growth and gave a bump higher to its inflation projection. Officials now see the economy accelerating at just a 1.7% pace this year. This is down 0.4 percentage points from the last projection in December. In addition to this rate decision, the Fed also announced a further scaling back of its quantitative tightening program, in which it is slowly reducing the bonds it holds in its balance sheet. Additionally, despite the uncertain impact of Donald Trump's tariffs as well as an ambitious fiscal policy of tax breaks and deregulation, officials say that they still see another half percentage point of rate cuts through 2025. Now let's go across and listen in to that excerpt.
In support of our goals, the Federal Open Market Committee decided to leave our policy interest rate unchanged. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor, an admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year.
Alright, then inflation remains somewhat elevated, and that's the word coming in from Federal Reserve's chairperson. But moving on, then meanwhile, there's some positive commentary coming in from Bank of America CEO Brian Moynihan, who also said that consumers are still shelling out money and economic growth should be solid, through though slower this year. Although consumers are shifting away from goods into services. Remember that this comes despite surveys indicating that confidence is at a nearly 3-year low amid increasing worries when it comes to inflation.
Now moving on, just a day after US President held a 2-hour-long conversation with Russian counterpart Putin, he held an hour-long phone call with his Ukrainian counterpart Zelensky. Trump said the call was aimed at aligning Ukraine and Russia in terms of their requests and needs, adding that the ceasefire efforts were on track. Zelensky said that a halt on energy strikes in the war with Russia could be established quickly.
Alright, then with that, we're completely timed out on this segment, but we'll see you on the other side of that very short break, and we'll take score of how the Asian markets are faring, so don't go anywhere.
Welcome back to ET Now. You're watching Market Cafe with me, Kanishka and Shreyansi. While the handover from US is very positive, here's a quick Asia market check. Well, the Asia-Pacific markets opened higher this morning, tracking Wall Street gains following the Fed Reserve's decision to hold interest rates steady. However, several indices have turned to red soon after. Hong Kong's Hang Seng Index was down almost 1%. South Korea's Kospi climbed 0.64% at the open, but is now down almost 1%. While Japan markets are closed for a holiday, China's Shanghai Index traded to 0.2% lower. Meanwhile, investors in Asia also await the monthly loan prime rate decision from China's central bank. The 1-year LPR, which affects the corporate loans and most household loans in China, is expected to be kept at 3.1%, while the 5-year LPR is expected to be unchanged at 3.6%. In terms of cues for the Indian equity markets, the GIFT Nifty implies an opening in the red, tracking Asian cues, that is trading down 0.2% lower from the Nifty futures previous close. Well, this comes after the Nifty 50 closed about half a percent higher, maintaining its 22,900 level.
So what we're looking at in terms of cues coming in from both the Asian markets as well as what we're expecting in terms of a handover coming in for the Nifty as well. But welcome back. Thank you so much for staying tuned in. Well, let's get to some important commentary then. Air India CEO Campbell Wilson announced a bilateral codeshare agreement with Air New Zealand and indicated an intention to start direct flights between India and New Zealand in the future. Let's go across and listen into that interaction.
We've indicated intention to explore a non-stop service. We're starting with a code share which allows people to travel more conveniently over Singapore, over Sydney, over Melbourne to a number of New Zealand cities and from a number of Indian cities. As we build traffic and get awareness and grow the tourism market between the two countries, then we can make a decision over which cities we would look to serve with a non-stop service. The most obvious pair would be Delhi, Auckland, but let's not prejudge things.
Right. The government has also come out with the Udan scheme. They want to target a lot of feeder routes, many small towns. What is going to be Air India's role in that? How many new destinations in India are you looking to increase your network to?
Well, it's contingent on the number of aircraft that we can induct into the country, and that's also contingent on the delivery of aircraft from the manufacturers. Some will be deployed on Udan routes, many will be deployed on non-Udan routes. We have a lot of opportunities still to go into in India, so I wouldn't want to name any particular routes because there's probably more to mention than you have time available.
Right. My last question is, what are the what other code share agreements you're planning? Would that be, without going into specific details, would that be more in Europe or in North America? What parts of the world?
Well, we have launched or expanded 20 code share agreements over the last 18 months or so. The focus has been with our Star Alliance partners, Singapore Airlines, All Nippon Airways, Lufthansa. We're working on some other Star Alliance relationships that we would like to have code share with.
Well, that's the word on more flights between India and New Zealand. Now, moving on, RBI has come up with its March bulletin, and it says trade wars and escalating tariffs could have a deleterious impact on growth and fuel inflation of global economy. Prices are expected to moderate through 2025-26, but it also highlights that high-frequency indicators of economic activity point towards sustained growth during Q4. My colleague Anjali is here with a detailed breakup of the March RBI bulletin.
That's right. The Reserve Bank of India has come out with its monthly bulletin for the month of March, and starting with the global economy, the central bank has noted that the trade wars and the escalating tariffs could have a deleterious impact on the growth across global economies and may also fuel inflation in these global economies. And this tumultuous external environment has also been reflected in the sustained foreign portfolio outflows that we've seen throughout the month, and this in return has exerted significant pressures on domestic equity markets in the month of February. But noting on the positive side, the RBI has said that the Indian economy has remained resilient, a part of which can be attributed to the robust sectoral performances and the improving consumption trends that have been seen in the country, and this is what is supporting Indian economic growth at the moment. And on the back of this, high frequency indicators are also pointing towards sustained growth during the fourth quarter. And the CPI inflation, which also reached a 7-month low of 3.6%, this decline to overall inflation is expected to also support recovery in consumption, according to the central bank. There's another positive that the RBI has alluded to, which is a good Kharif season. Upward revision in production estimate say that there would be a growth of around 2.8%, and so going ahead, this expansion in production across sectors is expected to ease prices throughout 2025-26.
All right, then there you have it. Those are some key takeaways coming in from March bulletin as far as RBI is concerned. But moving on, then the cabinet in its recent meeting announced a slew of announcements, including incentives for UPI transactions and approval for a gas-based urea plant in Assam. What are the other key details? Prakash Priyadarshi is standing by with all of those details.
Yes, it's a significant development coming in as the Union Cabinet has taken some significant decisions. The first decision with regard to providing financial support to promote, low-value transaction through Bhim UPI. The cabinet has decided to provide rupees 1,500 crore incentives to promote low-value transaction of rupees 2,000 through Bhim UPI for the financial year 2025. A very significant development coming in. Along with that, the cabinet has also decided to approve a proposal for setting up of gas-based urea plant in Assam. The plant will be set up within the existing premises of Brahmaputra Valley Fertilizer Corporation Limited with the financial support of rupees 10,600 crore. So it's a very important decision in the context of achieving Atmanirbharta in urea production. It's a very important decision going forward. Along with that, the cabinet has also decided to approve implementation of revised Rashtriya Gokul Mission with the enhanced allocation for the years 2024-25 and 2025-26. Along with that, the cabinet has also decided to approve construction of 6-lane access control greenfield highways starting from JNPA port to Chowk in Maharashtra with the financial support of rupees 4,500 crore.
All right, then that's the latest as far as the cabinet meet outcome is concerned. Let's shift the spotlight then to telcos. In a setback to telecom companies, then sources in fact informed that the government is not considering AGR relief when it comes to telecom companies. Reports had earlier stated that the government is considering waiving 50% interest and 100% of penalties and interest on penalties on the AGR dues of telcos. Sumita Karir is standing by with more updates on this. Sumita, tell us a little more about what the latest sources are telling you.
Yes, sources suggest that government is not considering AGR relief for telcos. This is a setback for telecom companies. Remember, the Supreme Court had earlier rejected telecom companies' review petition that was on AGR dues. In fact, telecom companies were expecting some relief to come in from AGR on the AGR front from government. Remember, that's been a contentious issue since 2019. And then there were reports that government was considering perhaps a proposal to waive 50% of interest and 100% of penalties on telecom companies. And the Supreme Court then earlier also dismissed these review petitions that were filed by telecom companies like Vodafone Idea, Bharti Airtel, that were seeking corrections in the calculations of AGR dues. And the Supreme Court's refusal to allow these corrections, the telecom companies now are left with no further legal avenues. Remember, telecom companies had also contended to the DOT that there were significant errors in computing the AGR dues. That includes failing to account for payments that were already made and incorporating non-core revenue. So that's the big news coming in from the telecom sector.
Well, that's the latest on AGR dues. Now, as the summer season nears, manufacturers across brands are gearing up to crank up not just the AC, but also AC prices. Sources tell ET now that brands such as Blue Star and LG will hike prices anywhere between 5 to 6% this summer. Is it just higher demand leading to hike in prices, or are there other factors too? Sameer Dikshit is here with the exclusive details.
Planning to buy an air conditioner this summer, especially April and onwards, then you have to pay a bit more money. And this is because that the AC players have decided to raise the prices of AC by around 5 to 8%. The AC players have said that the decision comes at the backdrop of multiple factors, and the important one includes the strengthening of dollar and the weakening of rupee, because of which they have to pay more when it comes to foreign exchanges. Similarly, the prices of raw material has gone up by around 5 to 10%. For example, copper, aluminum, steel and other such raw material. The prices has gone up, because of which the AC manufacturers are bound to raise the prices of the AC, and this entire the burden of the hike in the raw material has been passed on to the end customers. So players like Blue Star, LG and other players, they have already decided to raise the price, and the new product that will come into market April and onwards, that will reflect a price hike of around 5 to 8%. The AC manufacturers estimate that this summer season, it is going to be a huge demanded sort of a season where the demand for AC will be much higher. The estimated units for this summer season is somewhere around 15 to 17 million units, and they understand that the high demand and the price hike will not be an issue, because they are geared up to meet this demand. So this season, summer season, you may have to pay a bit more money when you will be buying an AC, but the players also understand that they are not going to raise the price henceforth. Going forward, there's not going to be any more such price rise of AC.
All right, thanks Samir for that update coming in. So looks like AC prices are rising in tandem with the mercury, but some more updates when it comes to air conditioners. The Centre has gone ahead and exempted select AC and refrigerator components from the mandatory BIS certification to prevent an acute shortage as India prepares for a brutal summer. In fact, we had the chance to take this up with Blue Star Management MD B. Tyagarajan talk to us, attributing the exemption to a likely shortage. Let's go ahead and listen into what he then had to say.
Copper, for example, this was brought in because you do not want spurious copper, or the copper tubes which are not conforming to the specification should not come into the country. Simultaneously, under Make in India, the companies were encouraged to set up these facilities. For example, Adani, Hindalco, MedTube, these are the companies who have invested. They are going to be producing these inner grooved copper tubes. Now, these productions are coming up. They will be able to scale, and the imports also will have to happen after the QCO approval. So it is the question of finding out what is the demand gap to begin with, and what is the to what extent you can scale as the market also grows. The market is growing at a CAGR of 19%. Yeah, in a summer season, the market growth may be 25 to 30% on a large base of air conditioners that are sold. And the inner grooved copper tubes is just not meant for only air conditioner. Many other categories also consume these tubes.
Well, that's the latest on rising temperatures and rising AC prices. With that, it's now time to slip into a short break. Stay tuned to ET Now for more news and updates on the other side. Welcome back to ET Now. Thanks for staying tuned to us. You're watching Market Cafe with me, Kanishka and Shreyansi. Well, not just summers, it looks like the competition in the wires and cables segment is also heating up, as the Adani Enterprises wholly owned subsidiary, Kutch Copper, has formed a joint venture with Pranita Ventures. My colleague Ashesha is here to tell us about the new entity, Pranita Eco Cables, and how exactly it's going to change the industry dynamics. Over to you, Ashesha.
Well, yes, competition is all set to intensify in the wires and cables businesses. Another serious player is looking to enter the industry. Adani Enterprises subsidiary Kutch Copper is looking to enter into a joint venture with Pranita Eco Cables Limited. This will be a 50-50 joint venture which the company has entered into in order to get into the wires and cables business. Now, the company says that the objective of the joint venture will be to manufacture, market, distribute, buy and sell metal products, cables as well as wires. So this is a big place, and competition clearly is all set to intensify in this particular industry. Remember, the capex announcement has not come in yet, although the company said that the initial capital will be of initial share capital, that is, will be of about 10 lakh rupees, but the total capex plans of the company for foray into this business has not been announced. UBS says that the competition is expected to intensify and it will be negative sentiment wise. Although capex has not been allowed, company can obviously go ahead and increase the capex going forward, and hence it is negative sentimentally for existing players, the likes of Polycab, KEI Industries and Havells. Remember, it was just a couple of days back on the 27th of February that Ultratech Cement also announced that they are looking to enter the wires and cables business. They had announced a capex of 1800 crores over a period of next 2 years. Plant will be set up in Bharuch, Gujarat, and it will be operational by December 2026. Now, as far as the industry is concerned, it is already huge and it is expected to expand going forward. In fact, industry reports suggest that global wires and cables business is expected to grow at about 7.5% on a CAGR basis. And as far as India's wires and cables market is concerned, it could grow at the rate of 11 to 13% between FY24 to 29 period. Share of exports was at about 5% in FY19. It has risen to 10% in FY24, and that too is expected to inch higher going forward. So clearly competition all set to intensify. Earlier Ultratech Cement and now Adani Enterprises is also looking to enter the wires and cables business.
Alright, and thanks Shesha for that update coming in. Tell you what, let's also get you the list of stocks that you should be keeping on your radar bright and early this morning. In fact, Varun is standing by with just that list.
Well, good morning, and keep an eye on NCC because the company has received LOA from Andhra Pradesh Capital Region Development Authority for the construction of roads, drains, water supply and other projects, and the total contract value is 2,130 crores. So keep an eye on this. IOB, the QIP has opened and the floor price is 42 rupees 70 paise, so that's discount to yesterday's closing. Keep an eye on Avenue Supermart, that is DMart, because the company has made an investment of around 175 crores by subscribing to equity shares of the subsidiary company Avenue E-Commerce Limited, and the price at which they have subscribed, it is 37 rupees 41 paise. Keep an eye on IRDA because the company has launched first ever perpetual bond to raise around 1,247 crores, and also keep an eye on NHPC because the company has considered and approved the borrowing plan for FY25-26, and the company is going to raise around 6,300 crores through debt securities.
Thank you, Varun. Well, those were the stocks to be on your radar today. Moving on, Gautam Shah, CMT founder and chief strategist at Goldilocks Premium Research, has a positive outlook on financials, metals and the PSU basket in this current market scenario. Now let's listen in to his market outlook.
That financial services have shown relative outperformance in these last 5 months when everything collapsed. I mean, to see SDFC Bank at 1700, I think is as commendable as it can get. And I think ICICI Bank, SBI, some of these top banks have done exceedingly well. And the bank nifty at levels of, current levels of about 49,000 itself, I think is quite a positive sign. So I think financial services technically, fundamentally based on smart money action, I believe is going to be one of the better trades for the next 6 to 12 months. This is followed by metals, which I think is going to be the star performer for the next 6 to 12 months. We are seeing some amazing charts. In fact, it's right on top of our list. And I think all top quality metal stocks could deliver anywhere between 20 to 40% from current levels. So these are my two favorite sectors where I think one can commit capital. Barring these two, power, infrastructure, real estate are three other pockets that we like. Everything else is pretty much an avoid.
Hi Gautam, good morning. This is Shrishti also joining in. But since you did touch upon the metal pack, and that is definitely shining bright on the back of the news flow, can you help us with your top picks within the metal basket, and what are your targets on the select companies?
See, to understand a particular sector, you need to see how it performs in the difficult times. And I think the metals index in the last 1.5 months has been absolutely range bound. And now as the market is starting to move up slightly, you are seeing metal stocks doing exceedingly well. So I'm seeing this as a mega trend. And if the index can appreciate about 20% and go back to lifetime highs, I'm pretty sure some of the top stocks in the metal space, the the JSW Steels, the Tata Steel, SAIL, Nalco, Hindalco. The entire pack has very similar charts. They could appreciate anywhere between 20 to 40%. And this in an environment where I don't even expect more than 10% upside for the Nifty. So I think there is great alpha to be made. And I think in the next move up, whenever it happens for the overall market, there will be new leaders emerging. So please don't latch on to the winners of the last 2 years. I think they will now be laggards.
That's such an interesting point, Gautam, that you had made, that the composition of leadership and, underperformance may actually change. Highlight what sectors do you see those kind of obvious moves in? You did talk about, financials, the larger pool, banks as well as NBFCs both. And maybe IT could be that one stark under performance that one has seen play out. Other than that, where do you think would be leadership and where do you think would be underperformance?
I think there's going to be leadership and value. I think India is always known to be a growth market. And I think growth stocks have done very well over the last 4.5 years. But I think now it's really time for value, because anything that's very richly valued gets hammered very quickly and gets discounted very quickly on bad results and bad news flow. We've seen this with so many stocks in the last 5 to 6 months. So I think all those stocks which are typically in that PE band of say 5 to 25 is something which I'm looking at. And what comes right on top of the list is the entire PSU space. In fact, we spoke about it to our clients last week, and we believe that the entire PSU basket can be one of the better performers over the next 6 to 12 months, because earnings are good, there is still under ownership, valuations are excellent, charts are very good, all have tested medium-term, long-term supports, and these are solid companies that don't get impacted with global issues. So in that sense, I think PSU is a sector that we like from a 6 to 12 month point of view.
When you say PSUs, Gautam, given that it's a very large pool, let me talk about the fancied one from the previous time that the markets were at an all-time high. And that was defense and railways, right? The froth, the frenzy, the first signs of correction, all played out in that segment. How would you approach them now?
Anything apart from defense and railway. I think railway was a very seasonal theme. It played out well. It became multi-bagger. All of the positives of the next 5 years was in the price, still is in the price. So I don't see it coming back soon. Defense selectively can do well. I mean, there are some marquee top 2 or 3 companies that can still stand out. But I would be more keen on looking at metal PSUs, power PSUs, infra PSUs. I think that's the space which I'm really liking from a longer term perspective. Because please understand, for 2 years, many of these PSUs delivered 3x, 4x, 5x, and thereafter, after that, corrected about 40%. Now, all are at long-term supports. So don't go by fancy stocks or the big winners of the last 2 years. As I said, new leaders will emerge in power, metals and infra.
One of the other connected sectors with the global markets, of course, is the IT space. What we are seeing is that from the September highs, Nifty IT index is already down over 12%, and even today the stocks are hammered. But give us your take on the IT space. Do you believe that more correction could trickle in some of these heavy IT companies? And what's your overall view?
Well, IT and pharma seems to have lost their trend and lost their way to some extent in the recent past. Mind you, they've had fabulous run-ups in the last couple of years, and I think they're going to stay in correction mode for a few months now. Many of these stocks were very richly valued. I mean, a 40p, a 70p, a 60p was getting justified in the good days last year, in the good period last year. But as the correction happened, people realized that this is not sustainable. So I think IT and pharma are 2 sectors where one should stay away. I don't see them outperforming, and I think it's definitely on our ignore list. Do not indulge in bottom fishing as yet, because I think the price correction is not done with, and the time correction is still awaited. So keeping that in mind, IT, pharma, capital goods remain an avoid even now.
All right, then that's some commentary to start your day right with when it comes to not just stocks but also sectors. But with that, completely out of time on this edition of Market Cafe on ET Now. Thank you so much for tuning in.
If you like this video, then like, share and subscribe to ET Now.